Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize both how you view our presentation and how you interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the file folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy Webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, in order to receive CPE credit, you must complete our attendance sheet, available in the file folder icon at the bottom of your screen. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. We'll email a copy of your PDF certificate in 2 weeks if you can't download it today. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Bertha Minnihan and Ryan Koch. Bertha has been in public accounting since 1995 and serves as the national practice leader for Moss Adams Employee Benefit Plan Audit Group. She has extensive experience directing all phases of audits for a variety of benefit plans, including 401k, 403b, pension, employee stock ownership, and health and welfare benefit plans. Ryan has been practicing public accounting since 2001, primarily serving employee benefit plans and venture funds. He specializes in all aspects of employee benefit plan audits, including 401k plans, pension plans, health and welfare plans, and SEC Form 11K filing requirements. Bertha, I will turn the line over to you to get us started.
Thank you. Thank you. Good morning, everyone, or late morning, I guess, or afternoon, depending on where you are, but we're glad you're with us. We love this webcast. Looking back at what we learned, it makes it all worth it, all the heartache and, and war stories we've seen. So today's agenda, we are going to cover what we've seen, some trends, operational defects. You know, that's what we learned from what went wrong and what we've seen, and we'd like to share it on this webcast so that it can get the audience thinking about what you've seen and what you've gone through. We're going to cover the new ASUs. There were new accounting standards this year, and we're going to kind of share those briefly. Then we're going to look at what's coming down on the horizon. So it's always good to know what the IRS and the DOL are up to and what's happening with our filing, and of course what's happening with the auditors, because that will help you all as well. So again, I think this is also a good time we have this webcast because you're all planning, and, you know, it'll help you for the year-end finish. So here's a polling question. We always like to start with polling. This one's going to be about, were you visited by the IRS or DOL in 2016 or to date? I guess I meant, you know, for the 2016 audit, or are you in progress? You know, do you have an audit going on in progress? So let's see if anyone's been visited, because the IRS and the DOL have been quite busy. So we'll let the polls go a little bit. Oh, wow.
There you go.
Whoa. I would have thought that would have been a lot more yes. So we have about 83.5% no and about only under 10% yes. So, and 7 of you don't know, so consider yourself lucky. Okay, and I'll turn it over to Ryan.
So we're going to start with the new accounting standards that were they were issued last year around, I think, July 31st. So we had a little bit of the 2015 year, but all of 2016 to either to choose to implement these or not. They are not they don't have to be implemented until I think even the end of next year, or until not next year, but the year after that. But these were very popular to adopt this year because they streamline a lot of the presentation, especially this one right here, the ASU 2015-12, where the FASB actually took an interest in plan accounting and some of the disclosures that were conflicting, confusing, didn't give good information to participants, were repeated in different areas of financials or 5500s or supplemental schedules, and just removed some of that complexity and some of that I'd say it's not very transparent when a participant picks up a set of financial statements and doesn't even understand what they're reading. So this hopefully got rid of some of that confusion. I thought it was a great standard. I encouraged most of my clients to adopt this. I actually think I only have maybe one that out of about 80 clients that I served that did not adopt this one.
Yeah, me too.
Yeah,
mostly did adopt them.
So the trend has been early adoption, and I can tell you that I'll just move on from that. And the other one, so this one is ASU 2015-7. This one is a little less popular to adopt, although only by a little bit. This affects investments in things like common collective trusts or pooled separate accounts. Basically, funds that are not mutual funds that are not traded on a public market, a public quoted market, and instead of trying to determine whether those fall within level 2 or 3 of the hierarchy, this standard just lumps those all together and calls those net asset value investments and puts them all on one line of the hierarchy table, instead of trying to determine whether they were level 2 or 3. Because some of the old method of trying to determine them was it was confusing, and it conflicted with some of the other literature, and it was very kind of it was kind of hard to figure out which one it was based on the guidance that was out there. And different people got it wrong, different people got it right. So now we don't even have to worry about that. Now it's just if it's a fund and it's not level 1, it's probably going to fall under this.
Yeah, and usually we have a lot of HR folks on the call. So
Absolutely.
I know, this is good for you to know, just so you know that there's things out there that can simplify your disclosure, especially if you're custodians or insurance companies, or you have the CCTs. It's good to just kind of know so that you can either review or engage a finance group, because they'll be aware of some of these, to kind of look at them. So if you are in HR and you're going, what does this mean? At least it's good to know, I think, because it'll simplify.
The only clients I had that didn't adopt this one were for large companies that had on a DB plan or something like that, where they had already reported their investments on their corporate financials for the DB plan, and they didn't want to go and reassess all their fund leveling and all that again. So they usually leverage that determination that was made on the corporate financials and then put them on the same information in the plan financials. They're going to go through this next year, though. So this is one of those things where most clients, so if you have a standalone 401k or a 403b or something like that, 99 times out of 100, these were put into place, both of these. So that was kind of the accounting update. Nothing coming down that I'm aware of that really affects accounting, the accounting side. There's some auditing stuff out there. I'm not going to get into that. It's very primordial at this point, but I think around this time next year, we'll have a lot of information about potentially new auditing standards or a new report that will have a different look and feel than it has in the past.
Yeah, most things are still in comment periods, and we've commented. Yeah,
absolutely.
That's safe to say.
Audit observations. So this is... We did this webcast every year, and it's funny because we go, well, how are we going to, what was different than last year? We do have some things that are different than last year, but most of it is still a little bit of some of the same. We have some new things that we're going to talk about right off the bat about fiduciary governance and payroll accuracy. These are things that are coming up more and more as we've gone along. Then we're going to go to our old friends, participant data and eligibility, eligible compensation, timeliness of deposits, and then use of forfeitures, which is something we've mentioned before, but I think we're gonna harp on that a little bit more than we have in the past. So let's move on right now to
And remember, you can issue questions. If there's anything you're not
absolutely.
hearing or seeing, I know we reminded you at the beginning, that offer still stands. We are going to take questions. We try at the end, but we don't want to, if we see something relevant, we are going to address it timely. So.
Right, absolutely. So if you have a question about what we're talking about right now, put your question as quickly as possible so that we can address it while we're still talking about it. Otherwise, we're going to leave about 10 minutes at the end to circle back and do questions.
Yeah.
So the slide here kind of says it all, and fiduciary governance remains weak. I would say that's a strong statement, but not untrue. Most of the time when we're talking about fiduciary governance, we're talking about generally the committee level. The committee level, I can kind of one thing that's happened to me over the last year is that I've actually become a fiduciary myself on our own 401k plans, and I've been sitting on our committees, and our committee meets quarterly for about 4 hours. And I'm not saying every company needs to do that, but there's a lot sitting in these meetings. There's a lot of things that the committee does need to be aware of and touch and approve and talk about and those kinds of things. And when I'm out on my audits, a lot of the time it may be an annual meeting for about a half an hour where we review investments, and that might be it. But there's a lot of other things that do need to be considered when it comes to fiduciary governance, and also just from a protection standpoint, hopefully everybody on this call, especially those that are fiduciaries, know that fiduciaries of the plan are personally liable for any losses sustained that do not fall under the 404C rules. If you're a fiduciary, you're not sure that whether you're compliant with 404C or
And the new DOL fiduciary rules, which your questions come up, so you can weave that in.
Yeah. So absolutely. So, and then also, again, that's a good point. The DOL issued new fiduciary guidance regarding brokers used and those kinds of things. So, if you are not aware of what those new rules are, how they affect you, whether your plan is compliant with the DOL rules, whether you're doing investment reviews and fee reviews, also plan operation reviews, any changes to the plan should be approved by the committee. All those sort of things. If you're not aware of those types of things and you're a fiduciary, you really should be. Right. Beyond that, all of that needs to be documented. And why I say needs to be documented, if it's not documented what has been done, it didn't happen. And especially in a court of law, it's very hard to prove that you did all the things that you're supposed to do for your participants when there's no documentation. Yeah.
So I sit on a lot of AICPA committees. I sit in my bio at the experts panel, and we work directly with the DOL. And so again, to the person in the audience that brought up the fiduciary rules, the DOL. We've talked to them for years, and they do agree that oversight is weak and that we as auditors cannot provide that oversight, right? We can't be part of the client or the plan's control. So from the top all the way down, no matter what size your organization is, make sure someone at the board has delegated a body of people responsible for the plan. And when we say responsible for the plan, we mean investments and plan operations, which people forget. Like Ryan said, we see a lot of meetings that go, oh, the investments are good, participation is up. Great meeting. And, we have half, and then we come in and we're like, okay, the investments lost money. Okay, nothing's on the watch list. There's no documentation of that. The plan, we find operational defects, some of the ones we're going to talk about today. Well, that was never mentioned, or none of those processes were reviewed so that they could be identified by the sponsor themselves and corrected timely. We're coming after the fact. So it adds cost and complexity to correction. And so this is why oversight is huge. And the DOL, like Ryan said, came up with these rules, and they basically affected the sponsor by saying, you need to know who your folks are, who's touching the plan. Why are they fiduciaries? Are you meeting with them? Do you have written contracts that says exactly what they're doing and how you are monitoring them? So it was huge, and I cannot stress this. We're starting with this, but we have a lot of war stories. I mean, the most famous one, of course, and Ryan, you've probably seen this, is the class action suits regarding investments. We've had plans where they've changed providers. I've had about 3 plans this year. They changed service providers and custodian, so, record keeper and custodian. They changed at a time when the market lost money. Well, the participants now are suing the committee, and the company, but usually it's the oversight committee and everyone else personally on that committee to go, well, wait, why did you change? Why did you liquidate? I lost money. So these are real stories, and a lot of them play out. Some are in progress. Some do get dismissed. However, it's a lot of time and cost for the sponsor to go through to go, wow, we've done what we could, especially if they don't have meeting minutes. It was impossible to show that anyone was paying attention to this plan. Right. And that's the key, is if you don't document it, like Ryan said, it didn't occur, and then it's hearsay. No one's going to believe, hey, I walked down the hall and I talked to my CFO about the plan for an hour. We talk all the time. I hear this all the time, right? I email all the time, but there's no record of it. So in essence, it did not occur.
If you're emailing all the time, though, that you got good news, though, right? Because here's the thing. Now, if you go down the hall and you talk to somebody face-to-face and there's no record of that, that's you did something, but you've got no proof. You got an email record. At least you got something written down. So file that away, right? You've got a decision process already documented. That counts. You don't have to have a meeting with approved minutes and all those kinds of things. If there's a decision-making process in an email chain, even with the committee involved, that counts. That's documented decision-making.
Right. And as auditors, we get so many questions, right? I mean, you guys do a lot during the audit process. Well, document some of that. Met with the auditors, reviewed findings. We have a game plan, or we had no findings. There's a lot.
Absolutely. Absolutely. I will say one more thing about this. If you're unclear on where to start when it comes to governance, especially when it comes to investment reviews, there's a litany of investment advisors that are independent of your providers, of your custodians, of those investment managers that know this business inside and out, and they know how to protect the fiduciaries, and they will come to your meetings, they'll run the meetings, they will take minutes, they will keep the minutes, they'll do all those.
If you're a one-man show, a one-woman show, they will help you set up those committees.
I cannot. Moss Adams has one. I wouldn't know where to start as my own fiduciary to start removing investments. They are somebody that we count on very heavily to do that. We also have our external attorneys come to every single one of our committee meetings just to give us a legal update. What's the legal landscape look like? One for benefit plans. How does any of this affect us? These are not bad things to have.
No. Great.
Okay.
So now that we scared everybody a little bit, let's go.
Now I'm going to talk about payroll accuracy, and this is a new one for me. I mean, something that I've seen since I started this, I started doing this, back in 2001, and it got sold out. How long I've been doing this? Early in the process. Not quite as long as Bertha, though.
Yeah.
But
age is relative.
But what I'm talking about with payroll accuracy is that when you go back and you look at payroll records, and you look at what the plan is actually receiving, I'm talking more at a macro level. So let's say my payroll, I go back and I look at payroll, and I say, for this pay date, $50,000 was withheld from participant checks or participant payroll. And then I look at what got transferred to the plan trust, and let's say it's $48,000. So you got a $2,000 short. And then as an auditor, I've got to look at that, and I've got to say, well, why is there a $2,000 difference, especially when it's short? Was that withheld and not remitted? Was that something, a correction? Usually it is a correction, right? But then what happens as an auditor is I'm saying sometimes a year and a half later, I'm asking these questions, and nobody at the company knows. Maybe the payroll person's left even, because bad records have been kept over what kind of adjustments have been made. Now, $2,000 is not a lot of money sometimes, but just one person, if you made a correction of $2,000 on somebody's paycheck, maybe even corrected it incorrectly, that might make a big difference. Sometimes it's more than $2,000. Sometimes it's tens of thousands of dollars or hundreds of thousands of dollars, depending on the size of the company. What really should be done here, and I've seen this more and more and more, I think, as companies are growing faster, especially in this area, there's a lot of moving parts when it comes to what people get paid and what's being withheld. And also, I hate to say it, but participant loans are almost 100% of the time the culprit when it comes to corrections on payroll. Well, participant loans are still, for all intents and purposes, participant loans are a participant contribution. They're subject to all the same withholding and late deposit rules. So what I would say is if you're making corrections to the payroll documentation and then remitting a different amount, then those records should be kept with payroll in a very clear way just to keep it, if anything, just to keep your auditor out of your hair when they come down, when they come, a year and a half later and start asking questions, you've got answers sitting right there. Let's just say the DOL starts asking questions, though, because they're auditing your plan. They're going to ask the same ones, and they're not going to be nice about it.
No.
We'll give you all kinds of time to figure this stuff out, but the DOL is going to be, oh, you don't have the controls? We're going to start dropping the hammer on you.
And there's so many reports available to you. Like, this is the part where, this is why, like Ryan's saying, we've seen payroll, a lot, but this past year we saw a lot of sloppiness, frankly, in payroll.
Yep.
And we don't know why when sponsors have so much access to reports. I mean, you can go online and look at what you withheld and what you sent. We've even seen it when it's the same provider. I mean, we don't like to drop names, but everyone's probably familiar with ADP, and ADP also record keeps plans. So, sometimes you have the same provider, so you can leverage off that quite a bit. But even when you don't, we're seeing, clearly it's a control issue because so many reports are available. So you have to see what was sent, what was withheld. Do you have off-cycle payments and paychecks? Why is that throwing people off?
Yeah.
We have manual checks, and everybody's like, we didn't know what to do. Well, then let's simplify your policy. Say you're not going to withhold from final checks. Or let's have someone review monthly, did we have any of those?
Absolutely.
Put a control in that matches your company and what you're trying to achieve, from a benefit standpoint. Because a lot of times, it's the one-offs.
Right.
One-offs that kill you, but those one-offs, like Ryan's saying, if the DOL is looking at the one-offs, they show poor controls. And then they open it up. They continue to peel the onion.
Absolutely.
Right? And go, oh, no, well, that's what controls are for, those one-offs, and you didn't have those, so I'm going to look at every one-off you have, and you don't want to be open to that.
Right. Those off-cycle for final paychecks, so I see those like maybe one out of every 25 clients I have or something like that. And I always ask the question, why are you doing it this way? Because and I bring this up now is like if you have like an off every time somebody leaves the company, you write them a check on the day that they leave, and you do with a 401k withholding and FICA withholding and yada 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 and all this stuff. It's a big to do. I would ask yourself, why are we doing it this way?
Why are we doing
because
it? Exactly.
I would say you're in the minority, and it does complicate things. Now we come from the 401k only school in this, at least in this presentation. I'm sure there's other complications when you do an off-cycle payroll that we're not thinking about right now.
Sure.
But if we're just talking about 401k only, it's a bad idea because these withholdings get forgotten, they go late. We have like a special control for off-cycle payrolls, like we'll do our normal payroll cycle within 2 days, but off-cycles are like 7 days, and then you start asking the question of why is it that way? So I would rather, if you're looking at that at an off-cycle payroll for terminated people, think about, do we really need to be doing it this way?
Right.
Anyways.
And then change in providers, you want to? Oh, I can touch on that because this is I saw a lot of war stories in this area. When there is a change in payroll provider during the year, a lot occurred. So one of the bigger things, and we're going to talk about compensation, is the codes didn't transfer correctly, right? So half the codes were dropped that were eligible for deferral. That's super costly, and it's really hard to fix. Payroll timing was changed. We were twice a month. Now we're once a month, or we're 3 times a month, and so it's been hard to do that. We had one client I had that changed payrolls. They missed a whole class of people from withholding. I mean, I don't know how that occurs, but a whole division was being paid, but their deferrals hadn't kicked in. So you might say, but it wasn't withheld, so is it really an obligation? And it is, because the DOL will say still how to correct that is to, you have to still cover, like I think a half or whatever, 25% deferrals or half a deferral, 100% a match, and earnings. There's still a lot that goes into that correction.
I think we had one where we had accumulation problems also, right? Where the accumulations didn't transfer correctly or they didn't transfer at all. And that poses a problem for the auditors sometimes because now we're looking at the full year for somebody's deferrals. But now I got to look at 2 payroll systems to figure this stuff out.
So we're getting a lot of questions on how should final paychecks be handled, right? If you have someone, you're paying them on the last day of employment, what's happening? Yeah,
generally, I mean, I haven't really dug into this very much, but when it comes down to it, I mean, don't we just, for the most part, I think they just get paid in the next pay cycle for what they're owed. I mean, process that final paycheck. If it's not a manual check, it should follow the same process.
Exactly. So I think that's where we're perplexed too, if you will, is if you have people the way you terminate them and you exit them, they have a final check. It's not post-severance, right? So it is they're literally their final check.
It is earnings.
It is earnings.
Yeah.
There should be a final withholding, and it should not be a manual process. It should go through the payroll system along with all the others.
Absolutely.
If you have to pay them off cycle, you might want to say, you know what, that's not going to be eligible for deferral, frankly, if you don't have controls to process that.
Yep.
So you might say, you know, we're going to pay them through whatever the 12th, but, you know, their next cycle would have gone, or, you know, we're going to pay them the 15th, but they left on the 12th. So we have a few more days. Well, you might just want to put as your policy that those few days are not going to have deferral withholding. So that's what I saw when I came up with this year, and we worked with clients to put in controls. They just simplified things. You know, they said, hey, here's our process. We'll pay you on the last day of employment, but if it's not in line with our regular pay period, we're not going to withhold. Yep. They're just not eligible for deferrals.
And that should be written into your plan
document. And it's written in a policy,
yeah.
Exactly. And it's told to employees as you terminate that, hey, you're going to have a final paycheck. You know what I mean? And that.
Right.
So
but I'd say most of the companies that I'm seeing, it's just, if you got paid, you know, we got a 15-day payments or payroll cycle, and you're terminated on day 7, then you're going to have to wait 7 days to get your final check.
Exactly.
And that's the way that goes.
Yeah, and you can do that, or you can also, I mean, we're getting questions on, well, if it's a final check and you just said it's earnings, how can you defer? You can, because you can call it post-severance. You can call it a certain thing and say, you know what, if it's after our normal pay period and it's going to be totally off cycle, it's considered post-severance, and those earnings are excluded from deferral. That's very normal.
Right.
So we've seen that quite a bit.
The thing being that you're being paid after you're an employee, right? And if you're not an employee, you're not eligible. Right. So that tracks very, very simply.
So I hope that doesn't muddy it, but again, just stick to your pay periods. If it's going after, you might want it excluded unless you really want to put it in, you know, in controls to watch that.
Right.
We had one, not to go back, but we did have one. We're getting a lot on meetings and things like that. And of course, again, we said once a year holding meetings for fiduciary governance is enough. But again, I would say, as I think I covered this in some of the war stories, is if something's happening with the plan, like you're changing providers, meeting once a year is not going to do it. So depending on plan activity, you do have to meet more often to make sure you're following through on your fiduciary governance. But if it's a quiet year and you're meeting annually to review investments and you're doing watch lists, that's absolutely acceptable.
Yeah, I'd say at least annually. And whenever I'm looking at whenever we're starting an audit up, we'll look at, you know, we always ask for the minutes of the plan meetings very early in the process. So while we're planning the engagement, and if they're like, oh, we don't have any new meetings, I look at, well, when was your last one? Oh, it was in March 2015, and it's June 2016 right now. It's been a year and a quarter since you've had your last meetings. Like already, I'm already starting to, my wheels are turning. Your governance isn't quite there, right? It's at least annually.
Yeah, and once again, just more questions on, you know, final page. Yes, the monies do have to be paid immediately on the last day of employment. Again, we're not changing when you're paying. We're just saying you have leniency with how you treat those monies for deferral purposes. So just to clarify again, we're not changing the time you have to pay or any California law. Okay, participant data, our favorite.
Okay, so this one's very easy for me to tell war stories on. It's the improper exclusion of eligible employees is the number one thing. And this, I've talked about this. You know, if you've been on this webcast before, this is going to be old hat. At least if you were paying attention last couple of years. So the most common thing, and I'll just jump. So this basically says that the plan document says that certain classes of employees will be eligible and certain classes of employees will be excluded. And those classes of employees that are eligible for 401k may be different than what's eligible for all the other benefits, say health, insurance, or life insurance, all those other things. Because those are more policy type eligibilities, and the 401k is governed by a strict plan document. So what I'll see, let's just start with part-time. Part-time's a very easy one. Part-time employees, a lot of the times less than 30 hours, may not be, I'm just throwing out a number, may not be eligible for health benefits. And somebody in HR may just extend that to the 401k plan without really looking at the plan document of the 401k plan to make sure that part-timers are in fact ineligible to participate. Well, generally the 401k plans, also the law says that if you work over 20 hours a week, then you are going to be eligible for 401k no matter what because you're no longer part-time. That's the 1,000-hour rule I'm showing right there. So right there off the bat, we've got a disconnect of 10 hours at least. But let's just make something more cut and dried. Interns, you go like no health benefits, no problem. They're here for a little while. We just don't have health benefits. But if I look in the 401k plan document, it says all employees are eligible at all times. Well, were interns employees? Yes, they were on payroll. We paid them for 3 months during the summer or whatever, and we didn't even hand them a packet. We didn't even tell them about the 401k plan because they're not eligible. Well, guess what? They were. Because the plan document did not exclude them. So the correction on this is that you have to go fund an account for all those interns that you didn't let in, as if they would have participated. And yeah, there's some reduction on that funding or whatever, but you can't true them up and say, oh, we paid you $2,000. Sorry, we're only going to pay you $1,800 and put $200 into the 401k. No, that money is employer money that has to be funding their account.
Yeah. And questions come up, and we were going to cover this, the opt-out.
Yep.
Right. What if there is no opt-out? And because we come in and we look at, as a firm, the risk of improper inclusion/exclusion, right?
Yep.
But a lot of times clients don't have an opt-out form, right? So, how do you know? How do you know you offered it to employees, right? And I actually do recommend opt-out forms. I believe we have them at Moss. We have to always negatively, respond, if you will, to benefit. So I would say I would go that route. If you do not have it, I would say then you need controls over how do we determine that the right people are in and the right people are being excluded. It gets tricky. We have 3 months wait, and then they come in the quarterly. We've also seen clients with a very complex eligibility requirement.
Yes.
And sometimes I'm not sure why it is so complex. Unless you can have separate eligibility rules for matching versus employee deferral. So, if a company's trying to manage cash flow somehow for their year-end match or a profit sharing, you can do that, regardless of how you have them eligible for employee deferrals. So you can also think of that and go, well, maybe I don't want to pay match for everyone, so I'm going to put some exclusions there. They have to be employed for a year or 6 months or at the end of the year. But for employee deferrals, you have to be careful. So I've become more and more a fan of the opt-out. And I guess if not, I would say really have strong controls to do that. And some plans did have later opt-out, by the way, which I've seen. But again, if I say half of those had issues because, again, there was no controls. You know what I mean? Like they had 90 days to opt out, but within those 90 days, that wasn't monitored. So nobody opted out or everybody opted. And so, you got to really be careful. I say, again, simple and monitor.
That's I think, the main thing. For the next couple slides, I think the biggest thing is, number one, understand, right? Yeah. Understand what your eligibility requirements actually are. And also, if you have auto-enroll, auto-escalation, which we're kind of going into, we're going to talk about opt-outs.
Yeah,
right?
because a question came up on that. We're there now.
Yeah. So read your plan document. Understand what provisions say you're supposed to be doing, and then go to the committee and talk about plan design. Let's talk about demographics. Do we have issues where we're going to fail non-discriminant tests if we do include these people, and if not? Let's keep it simple. Just let everybody in immediately. Those kinds of things.
Auto-enroll is a form of simplification, but you'll wonder why we have it as a problem list, right? We have it because it hasn't been kicking in.
Absolutely.
So where we saw, which can be costly, again, whether it's withheld or not. So that's why we have it here is worse results in the past, because when it first came, it was working beautifully, right? People were like, we're done. Everybody's auto-enrolled. Participation went up in a lot of companies where they didn't have good participation. But then now we come and no one's monitoring it. It's not kicking in, like when it should. Someone's hired on 1/2 and it's not in the payroll until 1/31. Well, that's a delay if it's supposed to be in the pay period right after.
Right.
So we're finding the loans. If they brought in a loan, it's not kicking in. So it's a lot of things with auto-enroll that I agree it's a nice way to keep it simple and have everybody in. Same for auto-escalation, not kicking in on time.
Right.
But again, make sure it's done correctly. And then if you have a match, right, you need to account for that and make sure that the people you're auto-enrolling are also getting the match. Or do you want to simplify, or I don't know if that simplifies, say people aren't, again, eligible for match until they're here 3 months. even though they're deferring, but that complicates the definition.
Right.
Because we had a client, I had several this year, when they looked at the trend, a lot of people were opting out. So they looked and they determined that it was the investments that was making them opt out, frankly.
Yeah.
So they changed the investment lineup. But until then, the match was getting very muddy, right? Because they kept matching and everything would come out. So that's why, I think it's a nice way to simplify, but again, you still have to monitor to make sure, and the compensation, of course.
I think Autoenroll is one of those things that people think actually simplifies the plan, but it does complicate administration. Because now we're like, well, now I don't even have to administer what percentage they put in or whatever. But if it doesn't happen at all, or because you still got to look at it, you got to look at least look at an employee census annually and look at hire dates and participation dates and those kinds of things, like at a top level, and say, well, where might the problems be? And
that's why I changed the slide. I mean, really on the control level. Yeah.
Dovetails quite nicely into controls. I want to skip ahead to the last bullet here because controls are somewhat boring. But the biggest thing that I want to ask you about when it comes to data controls over the participant data, this is controls of how we enter things into payroll, how we enter things into the HR system, how that information from payroll and HR gets to the record keeper and the controls over that. Ask yourself, if somebody made an error in the entry of participant data, would anyone at the company ever catch it, right? And that's what I constantly ask my clients is, let's just say, let's go through your process. Okay, one person is entering this all in, and they do maybe a spot check review at the end, and that's it. That's how we enter in all the deferral rates into the payroll system, or all the people into the record keeper system when they get hired. So I ask the question, let's just say you made a mistake. Let's say you transpose some numbers in a date. Let's say you put a spelling error into their name or something like that, or you put their social security number incorrectly. Who would catch that? And they go like, I don't think anybody would. Maybe the participant would. Maybe. Yeah. First off, don't rely on the participant to catch errors ever. No. That's a bad idea. Number two is you can't rely on the auditor to catch the errors either. So if somebody else, you got to ask yourself if there's somebody else that would catch those errors. And then the last bullet is, let's just say somebody wanted to make a quote unquote error, right? Mm-hmm. Does your answer change? Yeah. If somebody wanted to go in there and start monkeying with the system for some reason, would anyone catch that? Yep. What's to stop them? Now, the benefits for doing that might be questionable, but still, if you're in there if you have any opportunity to do that with no oversight, that's a problem.
So here's some more war stories, right? Hire dates. We've seen a lot of fraud in people setting up employees that don't exist, setting up double employees with one change in the social, and then they pocket the deferrals. Same for termination dates. Let's keep them alive for another 2 weeks or 2 months, get their deferrals from fake, payroll, and goes into the account, and they take the money. A lot of fraud occurs in participant data, especially, and we've been talking traditional 401k. We look at obviously a lot of plans at Moss. We audit over 1,500, so we have health and welfare, defined benefit, pension. So we look at a lot of participant data, and again, our first question is, what are your controls in reviewing it's accurate? And we find a lot of errors. Large hospitals. I mean, I had 2 large hospitals this past year where hire dates were incorrect because a bunch of people were hired in a month. All their hire dates were the same. So that screwed up things because for vesting and for benefits. And it was like, oh no, how did that happen? They don't know. It was a system glitch. Part of it was something else. So we expanded our testing. They did an on-site audit. We held the issuance. I mean, and it was only like 1 month, but it was a real thing. So, these are real, again, review things. You don't have to review every week. Mm-mm. Monthly, quarterly, annually? Annually, yeah. Like, this is a great time. This is why we do this webcast now. You really have time to fix W-2s and fix a lot before year end.
Absolutely.
Look at your new, sort your data. Look at the new hires. Look at the terms. Does it make sense? Did one division lose more or less? Did one division grow abnormally for no reason? Do analytics like we do that could really help you.
Absolutely.
So we're at a polling.
Absolutely.
Oh, and we're getting great questions, everybody. We're not answering them because we're going to get there. Yep. But keep them coming. So how often do you review your administration of plan administration, such as payroll accuracy and timing? Now, be honest. Be honest.
We don't know who you are.
We don't know who you are. Yeah. It's anonymous.
Quarterly ? Is about half of you do about quarterly, some annually, and some most doing during the audit. Although, technically during the audit is annually also. So
yeah, so not bad. So it's 50-50 almost, annual versus quarterly.
It would be. So one thing I will say about during the audit versus annually, which I'm interpreting annually as during the year that it's actually happening, and during the audit is up to 9 months later.
Exactly.
I would say if you're doing it during the audit, you're probably doing it a little late, just because you're already in correction land at that point. There's no. You're going to have to go back almost a year or more to correct.
And again, super easy way, just review your data now. You're doing W-2s, great way to go. How, did we look at eligibility correctly? Mm-hmm. Super easy.
Eligible compensation. So eligible compensation is another popular topic, and this is one thing. I'm not going to get too down and dirty on this, but it's the same idea as the eligibility, which is your plan document says what types of compensation can be withheld on or has to be withheld on, and what kinds do not get withheld on. And there's a lot of questions about first off, I don't think a lot of people understand what different compensation codes are and what they fall under, whether it's W-2 or 3401A or 415 Safe Harbor or something else. I just spouted off the three most popular types, and a lot of people kind of, even in our business, in the audit side, don't understand what's in those and out of those. And if you don't understand that and that's your policy, you've already got a problem because you don't know what to include and what to exclude. Then you get into weird compensation codes like restricted stock units, which I see all the time around here, or the deemed gain on a stock option exercise, right, which is W-2 compensation, and you're supposed to withhold on that. Right. Well, if your 401k definition is W-2 compensation, then you should have withheld 401k on it also. And I get the question every year, at least 5 to 10 times. But Ryan, how can I withhold 401k on a deemed gain on a stock option exercise? There's no cash there. There was no cash. It was just on paper gain. I'm like, well, you withheld federal income taxes, so how can you not withhold 401k as well? Mm-hmm. And they kind of go like, well, it's hard. And they say, well, this is what your plan document says that you're supposed to do.
Again, keep it simple.
Absolutely.
Understand the definition. There's 3401 that I still don't understand. Then there's W-2.
Yeah.
Keep it simple. Look at your definition and go, is it working or not, right?
Right.
So, you know what I mean? You don't want to, again, complicate things, but another very costly area.
Right.
So we have a grid. If you're our client, you would have seen our grid. And the grid is just a little check that you send to payroll, and you go, payroll, what are you doing? So Please start there. I mean, a lot of times when we send it, they'll send me the plan document. It's like, that's not what I'm asking.
Right.
I'm asking you to go to payroll and say, what are we doing? Where, who are we? What are we doing? What are we withholding on? And then go from there because, again, a very costly area. So if you want the grid, let us know. Again, our clients should have seen it all.
Right.
If you have new payroll people, like we do ask, have you had change in payroll? So if you're in human resources, I think you would know if you have new payroll folks or a new provider. Then stop and go, let me call and see if they have, if they have the definition of comp and if they understand what's going on.
Yep.
Yeah.
Okay.
Okay.
Timeliness of deposits.
Yeah.
My favorite. I think actually timeliness has gotten a little bit less contentious than it has in the last. I've kind of changed my tune of how I communicate what timeliness of deposits is. I mean, just to give you a review real quick, this is all participant withholdings, whether it be participant deferrals, normal deferrals, Roth deferrals, catch-up deferrals, and participant loan with repayments. All of those fall under this. Anything that's participant money that you're taking out of their paycheck falls under this rule. They need to be remitted to the trust as soon as they can be segregated from company assets, but in no case no later than the 15th business day of the month. But the functional rule we know is the as soon as possible rule, which the DOL has been very aggressive on upholding. And I think we've been through this enough where we know what trends really look like. If you look at your deposit schedule and it looks like you get it in within the same day to 2 days after, and then you've got one that's 5 days after.
Right.
The DOL may come in and say that 5 days is late because you've demonstrated that you can do it within 2 days.
Yeah.
5 days is a little aggressive, I would say, but if it's 7, 9, 10, 11, those are definitely going to be late. And I've been basically telling all my clients, and they've responded very well, if I see that 9 days, if I see that 11 days, I say, you can do what you want. Mm-hmm. However, these are late.
Yeah.
I'm not saying these may be late.
Yeah, the DOL will call
yeah, absolutely.
Yeah.
If I'm the DOL, I'm coming in and I'm making you correct these. You should correct them.
Yeah. As a firm, that's what we do. We do, we don't report ones out of your policy delinquent.
Right.
But we do let you know, and which is the truth, is DOL might come. But we don't also, because the DOL can come and totally blow your policy out of the window, by the way.
Right.
Right? Because we've had, again, I've shared this where I had a university of 20-plus payrolls. The DOL came and they were doing 7 days, and I thought that was great. The DOL came and said, you got to do them all in 4. They have to hire people to remit by 4 days in every location for this university. So the DOL can come and do quite a bit.
Right.
We're getting a question, of course, withholding creates the obligation. But even when you don't withhold and you were supposed to, you still have correction issues.
Yes, absolutely.
Right? So that's another question that
came up. That's a different issue, though.
That's a different issue, yeah. If you say, wow, we missed a bunch of people in January, then we realize in November that, oh, crap, we have to withhold from them.
Right.
You still have to do certain corrections and cover a certain percentage of.
Right. The correction is actually that the company makes up what they should have withheld. It's a half of it or a quarter of it, depending on certain circumstances.
Right.
If you get into any of these circumstances, whether it's a late deposit correction or we messed up and forgot to withhold, or we over-withheld, or we overmatched, or whatever, any sort of correction, talk to an attorney or a correction specialist to help you navigate the process.
Exactly.
Because I would not, and you can start with your provider. Sometimes, like bigger providers like Fidelity and Vanguard, they have the people in-house that can help you get through it, especially if it's a simple one.
Right.
If you're going like, oh, we missed the division for 7 years, you probably want to go see an attorney, right?
But again, review your policy. So now we're in November. Great time to get a little printout from payroll. What did we send, or wire transfer, or your provider for that matter? Provider, what would my remittances look like? And you can get a list nicely that shows you remitting every month by what date, right? Mm-hmm. Or again, our grid that works, we ask clients to summarize the year. Works great, and that's why we look at it in one shot. We have another question that what exactly triggers the obligation. It's pay date, not pay period ending.
Correct.
Okay, so we have confirmed that. I know a lot of firms take the approach of it's a pay date. We don't. That's not
accurate. Or the
accurate.
Pay period ended.
Or the pay period ending. That's not correct. It's the date that the actual check is cut to the employee.
Right, because that's when the clock starts ticking. It's like this is the time that the money was actually supposed to go to the person. So if I was supposed to pay somebody $1,500 and I withheld $200, so they only got $1,300. Well, what happened to that $200? It's got to get into their account. It's got to get into their account timely. We're taking a loan from our own employee right now. We got to get rid of the money. It's a hot potato.
Yeah.
This is not our money. We got to get rid of it. So
we have some best practices that I think, we covered most of these.
Yeah.
Right? It's basically, but this is a great time to review.
I think the one thing that Bertha touched on is be realistic on bullet 1. When you're determining your company standard for what as soon as possible is, let's be real. Like, let's not. Don't set a standard you can't hold yourself to, but don't set one that's like, oh, it's in 30 days, because that's not realistic either. You got to do it within the standard, and you got to do it something that makes sense for your company.
Exactly.
Hold yourself to the standard as much as you can as part of your normal controls. Here's the thing. This is I say this every time. It's probably better to not even have a standard than to have one and then just give yourself all kinds of exceptions on it. I'm going to set my standard at 5 days. Well, then we had 7 days. Well, we're not going to correct that one because it wasn't that late.
Exactly.
So you don't document and have a full standard out and then just say, just ignore it. That's pretty bad. Because then you're basically calling out yourself to the DOL. If you ever come on audit, here's what is our standard. And then they're going to automatically start asking questions about why didn't you hold yourself to your own standard.
Yeah.
Document deviations from the standard, including making necessary corrections. If you have an exception and you're making it okay, then
document it.
Then document it. Yeah, you don't want to go digging into this a year and a half later as part of the audit or years later as part of the DOL.
Yeah.
And then consider off-cycle payroll runs. They may have different controls, may have a different standard, but maybe they'll be the same. You still got to think about it. All right.
We have a polling question. We did hear everyone. Sorry, we went a little too quickly on the last one, so we're going to slow down.
Okay.
Make sure you guys answer it. Sorry about that. We get on such a roll, and there's so much to cover. So have you had to correct some of the stuff we talked about? Eligibility, participant data, eligible comp, late deposits, pick your vice. So
we're going to give it 5 more seconds.
Yeah.
It'll be painful as we wait 5 whole seconds.
A lot longer. We're going to wait more. No, hold on.
Okay,
what happened? Did it get through? I don't see it.
Wow, okay.
Okay, hold on. There we go.
So this,
oh my gosh.
This sounds about right to me. And actually, I think the people that have answered no, that are going like, oh, I hope that never happens to me, it's going to. This is what this poll is saying.
Don't sit there all smug.
Yeah, this is stuff that happens. We see it. I see payroll problems or some sort of control problems on half of the engagements I do. So this looks totally right to me. So definitely be aware. If you also don't beat yourself up if you have to do these corrections, like, oh, we're a bad HR department or what payroll department. That's a great
point. Yeah, so it's okay. Seriously, to me, and don't brush it under the
absolutely,
yeah. So to Ryan's point, you're in good company, if you will. If you're seeing some of this stuff, your plan is alive, it's thriving.
Right.
But definitely have these controls in place. The stuff we covered are real. They're costly. They are occurring. You and your employees deserve the best. You are a participant. I always say most of the folks on this call, or all of them, are participants, like Ryan is in our plan, even though he's a fiduciary. So your employees deserve the best, you know.
One thing I will say about what you're saying about the red, so I get the red flag question.
Yes.
Okay, which is, oh, well, I tell a client, this is late. You should correct. And they go like, well, I don't want to. First, there's an administrative burden, and I get that. I'm not going to sweep that. This is an administrative burden, so you better be. If it's late, that's correct, but let's be sure it's late first. Let's just to say it should be done.
Yeah.
Then they go like, well, I don't want to do it because it'll set up red flags with the DOL, and then I'll get audited, right?
Yeah.
Or something like that. Don't do that. Don't even go there, right? Yeah. The administrative burden is one thing. You got to weigh risk. You got to say, what's my risk of, the risk of the cost or risk, cost benefit, basically. Weigh the cost benefit when it comes to these kinds of things.
And you're setting culture, right? I think the DOL looks at that, and we do. I mean, we have to assess management integrity. You don't want that integrity to be, frankly, questioned, not by just us, the auditors, but by the DOL, right? Because if you start having too many sloppiness that aren't corrected or are corrected half kind of ASS, half bad, it's going to set a trend that the DOL says, these people don't care about their plan, and I don't think you want that.
Absolutely. All right.
So we're going to go to another poll. We're going to go slow. You have plenty of time.
How many of your companies/organizations sponsor a defined benefit retirement plan or a retiree health plan? These are more popular than you think. They're not out. I mean, obviously, the vast majority of the plans we audit are 401ks, followed probably closely by 403bs. Which are just like 401ks, except a little bit different. However, we do a lot of DB plans. We do a lot of health plans. Just wanted to put that out there because there's some stuff to talk about there also.
Yeah, if we see a lot, we might cover. Oh, good. Okay. So not a heck of a lot.
Not a heck of a lot.
With defined benefits, since I'm seeing it the most, I think the only thing we'll say is obviously actuarial assumptions, right? So have controls and have a way to assess those.
Absolutely.
And then, of course, participant data.
Right.
It's really huge in defined retirement plans. So, all that good stuff.
Everything we just talked about when it comes to participant data for a 401k plan still applies when it comes to a DB plan as well.
Yeah.
Probably even more so.
Yes.
Because your entire funding, the plan's financials, the liability of the company, all of that stuff, all of it hinges on good participant data, good actuarial assumptions.
Great point.
Yeah. If you don't understand them, then you don't have controls over that data, you really should. It's the key on DB plans. Okay.
Okay. So
what's coming up?
So
Bertha, do you want to tell us about this 5500
Sure. Yeah,
overhaul?
I've been living and breathing this, being on the AICP experts panel. So the DOL is doing a huge overhaul of the 5500 and the EBSA system. It's a few years old now and needs a lot of tweaks. But of course, as they've been reviewing auditors and sponsors and coming up with all these new fiduciary rules and new accounting standards and seeing more and more audit quality, as they tell us, is somewhat on the decline, but we're really, trying. They said, you know what, the 5500 is something that all plans use to report. So can it be more useful in gathering more information where the DOL can have the oversight it needs in the right places, right? And I'm going to get on my auditor soapbox a little bit, is we get really slammed by the DOL. Why can't you do more? Why can't you do this, da-da-da-da-da? So, when they say that, we kind of sit back and go, well, why don't you talk to the service providers? And why don't you talk about, why don't you talk to the advisors and all that good stuff? So that's what they're trying to do with the 5500 overhaul. It won't be for several more years. I think with the 2018 year or something, or 19.
Yeah.
It's open for comment. We just commented. Some of our clients did. You can most certainly find it on the DOL website. But it's an overhaul in a few years, just so you know about it, right, that it's coming. And
I will say the most onerous part of this that I've heard definitely is that right now you say that all plans have to file 5500. Well, that's not exactly true. Yeah. Because if you're a welfare plan that has under 100 employees/participants in it, you don't have to a health and welfare plan. So if you're a small company that has a health and welfare plan, you probably do. Yeah. You don't have to file 5500 for that. Well, that goes away, and that is a big deal because that's a lot more 5500s that are going to get filed. So that's one of the bigger things.
And then the IRS and DOL oversight, again, because of audit quality, we're obviously sitting on Election Day. We didn't even realize when we picked this, it was such a historic day. Hopefully you're all out there voting. But as you can imagine, it's been tough to work in D.C. these past few months because everyone's anticipating change. So we are going to work with the IRS and DOL at the AICPA. But they have a lot of oversight. They've all hired a lot of auditors. Just this month, I track as the practice leader of the IRS audits being opened in all our offices for our clients. And I had about, one or two IRS audits, believe it or not, in every one of our offices. That's, 22 plus offices. But so they're really out there. So again, remember what what we're covering for you is real. Never too late to fix things, and it's okay to fix them. So you're in good company.
Right.
Peer reviews, again, auditing the auditors. So one of the responses the AICPA had to Department of Labor about audit quality was, of course, upping the way that we review one another. That's peer review. All the accounting firms have to go through that. As if you were not fortunate enough to be your auditors on the call, ask your auditors if they go through peer review, how their peer review went, what kind of comments are they getting on their benefit plan practice. That all helps. So, to, again, keep up audit quality. So I think that's where kind of our prepared remarks end. Yes. So we have some questions for you. I've tried to keep track. So Ryan, I'm going to throw one at you. One is saying, when we change the plan document, should it be approved by the board or the Fiduciary Oversight Committee?
I think the Fiduciary Oversight Committee is plenty. The board has delegated the authority of administering the plan and the fiduciary responsibility to the committee. Hopefully they have.
Hopefully.
If they haven't, then
the board is on
the hook.
Yeah.
Now, if the board is particularly interested in things like the plan document, then I don't think it's a bad idea to run changes by them or anything like that.
Yeah.
But the boards that I know, they do not care, and so it's not a requirement or anything like that. They've delegated the authority to administer the plan and make changes to it to the committee. I think the committee should definitely be reviewing those. Sometimes they don't do it as much as they probably should.
And remember, plan changes, we're saying oversight committee because that committee should also know who's doing what, because those changes have to trickle down to plan administration. Very important. Again, I had several clients this year. I read in the minutes a match was included. Autoenrollment never got to payroll, so it never was started. So you want to make sure that's why we're saying governance committee is better. Because they're actually at the front lines, boots on the ground. They can, then work with the right people that are supposed to actually implement.
Well, here's a good example, right, is that all the providers are having to rewrite their prototype documents in the next, either they had to adopt them last year or they're going to have to be adopted this year, 2016. You probably have adopted a new plan document either 2015 or 2016 if you're in a prototype at some point. Did the plan committee look at that plan document, the new plan document?
Yep.
I have a good advisor friend who says, what you should do is you should have somebody go into their office, lock the door, take each one of the new plan document and the old plan document and compare the provisions line by line. Yeah. And he says that when he does this for his clients, he finds multiple, like 10, 20 errors in changes of plan provisions that nobody caught because they didn't do this exercise. And yet the provider did their best in trying to translate old document to new document. It doesn't work all the time.
And that's why I thank the person who submitted this question, because that's one of the areas where we saw the error, was in the baton passing.
Yep.
Eligible compensation codes are messed up. Something's checked incorrectly. So we do a comparison too, but that's an excellent point to compare. We'll take one more question. It has to do with, how about if you found out that you should have been withheld a certain amount from a participant, you didn't withhold the right amount, and you noticed that later on?
I saw that question, and it said months later on.
Yeah, months later. How would we catch that up?
So now, I'm no correction. So I always say this. Ask me how many corrections I've done in my life. How many corrections I've actually followed through. The answer is 0.
Yeah.
I've found a lot of problems, but I've done 0 corrections.
That's the beauty of our job.
Right. But what I've heard is that if you catch it in the first part of the year, like it's first 2.5 months. Don't quote me on any of this, but so your correction specialist, your risk attorney for details. But if you catch it in the first period of the year, you actually can catch that person up and do the right and true up their pay throughout the year to make it as if they had done what they elected in the first place. Otherwise, if it's not in that small window, you got to make a correction as an employer contribution to make it whole.
The premise is no hardship for the employee.
Absolutely.
Right? You cannot cause the person a hardship and say, by the way, you're not going to get paid for the next 3 months because we screwed up and didn't kind of screw you up timely. So I think it's a case by case. I don't mean to punt, but I would make the employee whole. Be honest with your employees because they'll see that you're trying to do the right thing. We had a client that this occurred actually for a whole division again. There was 35 people. Well, we worked with them on the letter. 35 people got a letter of sorry, and some of them didn't max like they wanted to. So the company made extra contribution, fixed them, put the earnings in, everybody was happy. But, and then the next year, of course, the participant, they're going to put in controls to check. So I would look at it, definitely no hardship, but make it correction. And I believe, like Ryan's saying, is most attorneys we've seen is you make an employer contribution and cover the earnings.
Absolutely.
It wouldn't be considered delinquent. I haven't seen necessarily a voluntary correction program, but a correction.
One thing I will say about that is that, and a lot of companies think that this is fine, where they'll go to the employee and go like,
oh, God,
okay, here's the thing. We messed up. We're real sorry. How about we do this? How about we pay you like $50 less for the next 3 months, and then you'll be caught up. It won't be a problem. And you're not allowed to do that because what the thing is that the participant probably has their boss coming to them and saying like, look, man, I'm real sorry. We did this thing. It's all wrong. Why don't you just take a hit for the company and do this for us? And the employee feels pressured to say yes, right? Because they don't want to say no.
We've seen that.
Right. And that's against the law, right? So that's not.
And again, if we are your auditors, and even if we're not, please contact us. We have a lot of good consultants and attorneys we work with if you don't have one. And we can most certainly, direct you. There's a lot of great folks doing good work in corrections and identifying the problems we do, and they see this day in, day out, and they'll go to anonymous submissions with the DOL. They do quite a bit. Mm-hmm. So we thank you for being with us on Election Day, and I hope you enjoyed it. We, you know where we are. You have our contact information. You can go to mossadams.com and email us. I've had a few people ask for some of the grids. I'll be happy to email, and I'm now going to turn it over to Emily. Thank you.
All right. Thank you, Bertha and Ryan, for a fantastic presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon at the bottom of your screen. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE icon at the bottom of your screen. Open the icon and click the printer to download a PDF of your certificate now. I'll be keeping the webcast console open for a few minutes to allow time to do this. And if you have any technical difficulties or miss out, we'll be emailing the CPE certificate within the next 2 weeks. Here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you again for joining us, and we hope you'll join us again next time.